Hey everybody, it's Brian Shannon here from AlphaTrends.net. Today's Saturday, the 7th of April, 2018, and we just finished another volatile week. Let's start with the numbers here. We were down 1.3% in the S&P 500. NASDAQ lost 2%, being led lower by what had been our leader. The semiconductors are now down close to 5% year to date, and the biotechs are the worst group basically this year. Bonds lost some ground, financials, oil, you name it, everything except the volatility index. So let's take a look at the chart. And one thing that is certain is that we have a volatile market. The market hates uncertainty, and with a market below a declining 50-day moving average, that generally tells us that we don't want to be having much long exposure. On the flip side, though, we do still have this rising 200-day moving average, which is trying to find support. Right now, it continues to close above it on a daily basis. We've only closed below it one day, and if you go back in time, the approximate equivalent, of course, is the 40-week moving average. So we've only closed below it on a weekly basis one time since 2016. So technically, with a rising 200-day moving average, the longer-term trend is still intact. However, with a declining 50-day moving average, it says you better be taking some chips off the table and be aware that, especially with headline risk out there, the market's sending a clear message of volatility. And during these periods of heightened uncertainty, you should be reducing your exposure, even I think for a longer term investor. I think the risks are that we have the possibility we will continue lower. So let's take a look at what I think are some of the key volume weighted average price levels. Let me just clear that off. Here, this chart is constructed of 2 days. Each candle represents 2 days. It just allows for a little bit more clarity in terms of what we're looking at here, so the candles aren't all smushed together. If we take a look at the volume weighted average price from the January of 17, that had been significant last year, and we've not yet tested it. I think that it's likely that this will be a level that's tested in the next probably by the end of this month, and that's down at 252 and change. And if that fails to hold, the next bigger level will be the volume weighted average price since the election, and I like to color that one orange for some strange reason. The volume weighted average price since Trump, and that volume weighted average price comes in right now at about 248 and a half. So I think that it's highly likely that that level is tested. Now, if that were to happen, here's what could be a potential scenario for how the unwinding of the S&P 500 goes. If it gets, if we do turn into a bear market, we're in a bearish environment right now. But if we come down, let's say, test the 2017 volume weighted average price, bounce around in there a little bit, then drop to what would be the Trump VWAP right in here, and let's say we do some dancing on that for a little while. Well, at that point, what we would have is these, the 50-day moving average would continue lower, as would the 20-week and the 30-week or 150-day 40-week moving average would then start to flatten out and turn lower. And from there, I think that's where, in my mind, it's not down 10% or 20% that's a bear market, but it's lower highs and lower lows below a declining 30 and 40-week moving average. So that's what the potential risks are. As far as what's the potential for a recovery in here, it just doesn't look very good to me. You look at the daily chart, and again, the more times any form of support is tested, the more likely it is to fail to hold. And in this case, the 200-day moving average has been holding as support. So we have the buyers, stepping in there consistently over the last couple months, but the buyers' resolve will become, tends to get overwhelmed as more uncertainty comes into the market, and that more supply comes in as well. People are realizing that the market doesn't want to bounce as much, and we've got these declining moving averages telling us money is flowing out of the market. If we take a closer look at some of the key volume weighted average prices for this year, you can see here's the year-to-date VWAP. We're below that, and it's declining. That tells us this year money is declining out of the market. The average price the S&P 500 has transacted business at is 270 and a half, putting the average participant participant down by a few points. We are below the volume weighted average price from this peak, from these two lows, this low, from the gap on March 22nd, from this low, and we're also below the volume weighted average price from the low we had just seen a week and a half ago. So that tells us that sellers keep coming in and overwhelming this market. Be aware that we are in an environment where rally attempts are guilty until proven innocent. Let's take a look at the NASDAQ, kind of the same story here. I'm not going to spend as much time on this one, but here we see here's our volume weighted average price from July of last year. That's been holding. We haven't tested the 200-day moving average yet, operative word yet. I think we probably see that next week. In the Russell 2000, we are trapped underneath what two important levels right now. One, the year-to-date volume weighted average price. That's the purple line in there. The 50-day moving average is the green line, and that's declining. And you can see we are that we're stuck below there. We're also, looking at a rising 200-day moving average, and people will tell you that, if we're in a trade war, the Russell should outperform. Outperform is one thing. Outperform might mean down 5% versus down 10%. You don't put money into a market that it's declining. We're not here for relative performance. We're here for absolute performance. I don't want to lose less money than the next guy. I want to make money. We look at the market, we get involved in the market and take risk to make money. The trend line in the semiconductors, if we actually, let's take a look at a 2-day chart. You can see what I mean by the candles get too tight. So to change the scaling a little bit, we make each candle worth 2 days, and you can see here we've still got a rising 10, 20, 20, 30, 40 week moving average. And yes, we're experiencing a pullback. Here we can see the trend line maybe brings us down towards 90. The volume weighted average price since the election brings it right down towards that level as well. And I think that, we haven't tested the 200-day moving average yet. I think that's coming near term. The biotechs are a mess. They've been terrible. They're still trying to hold the volume weighted average price from 2017. These are levels I talk about every single day for subscribers to alphatrends.net. And if you don't, if you're not a subscriber or not interested, be sure to follow me on Twitter, because I put a lot more information out there during the week as well. But we've broken below what had been an important level, that volume weighted average price from 2017, and we're closing below it. Now we're down to the prior resistance in here. So clearly the biotechs are a laggard. We can see that on the chart. We can see it on the numbers, of course. But the market is in trouble right now. Money is flowing out. The market hates uncertainty, and we have that uncertainty via the trade war and all the posturing going on there. Let's take a look at gold. I've talked about gold, that it still needs to clear this 1375, 1380 area. We are still constructive. Let's look at this weekly chart. It's still constructive. We still have higher lows, and we still have this resistance in here. So it's not quite ready yet. The daily chart, we can look at that. That was just the weekly chart. This daily chart, it's still a big mess. We get these rallies where they get people excited, boom, boom, right here, and then they fail quickly. So it's not quite ready yet, but it's positioning to potentially, if it is to break that 1380 level, I think you could see it up near 1650 or so in a fairly short order. Now, as far as Bitcoin goes, I haven't spoken about that much lately because it's just been a disaster. We have a declining 50-day moving average. It did cross below that 200-day moving average. The key here this year has as far as resistance has been the volume weighted average price from the peak, and I'd pointed that out on these two occasions that it was likely to act as resistance. With a declining 50-day moving average, all these rallies are still guilty till proven innocent. I haven't traded in a while because what I look for in Bitcoin is for the sharp sell-offs with big volume to try to buy for a bounce. The market's rallying a little bit today. You can see here since UTC time, when the new Bitcoin day begins, it's gone from 6,600 to 7,000, and that's a nice little percentage move if you're a very short-term trader. But we still have even a declining 5-day moving average right in here. That's the orange line, and the volume weighted average price from the prior low in February, that's likely to become resistance if you are trading the long side. That's up at 7,600. 200. So still a nice distance away. Don't get me wrong. If you're a short-term trader in these, that could be, the potential level up, 7,500 to 7,600. But still, it's guilty till proven innocent. Here's a declining 10-day, 20-day moving average. I'm sorry, that is a 10-day moving average, a 20-day moving average, and a 50-day moving average. These candles are constructed with 720 minutes worth of data. In other words, 2 candles per day. So each so this is 1 candle for today so far because we don't have 12 hours yet. Anyways, I hope this video was helpful to you. I wanted to go a little bit slower and take a closer look at that S&P 500 because truly the market is sending a message. And as George Soros says, volatility tends to peak at turning point and diminish with trends. I think we're, if you look at where we are in the overall picture, we're not probably close to a bottom here.